Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at an update on a trade from literally a week ago on Lumentum, LITE, where an overbought and overvalued Lumentum finally had that long awaited pullback. The IV component really didn't go anywhere, so we were right on 2 out of 3 fronts, but that high IV allowed us to get a bigger net credit and get further out of the money, a little more protection. So let's jump in and take a look, shall we? And as we always like to do, we always take a look at our fusion approach, combining fundamental, technical, and IV analysis. As I said, Lumentum certainly on the fundamental side got overvalued, finally had that pullback. Certainly still overvalued, but much less so. Technically got overbought, certainly corrected that in a big way in a week. And IV basically flatlined, so didn't hurt us, didn't help us, but ended up being a very nice 1 week trade nonetheless. So taking a look at the technicals first, you can see here's the day we put on the trade last Friday, right? The stock had had this huge run up, had gotten certainly overvalued with a 9-day RSI poking towards 90, MACD hitting the highest level by far over the past year, but starting to weaken. Same with Bollinger percent B. So we always like to see it weakening. We have that doji formation, which is usually a pretty reliable indicator that the previous trend is coming to an end, where the stock makes a new intraday high but reverses and closes near the lows of the day. So that certainly is usually a good sign. Ended up being the case here. Did have a following day after we got into the trade where the stock did push higher but was quickly corrected, as we can see. 4 straight down days. Now the stock getting towards oversold levels. 9-day RSI basically nearing the lowest levels over the past year, right? MACD, right, by far at the lowest level. Bollinger percent B about to go negative. IV really didn't do much of anything, still hovering high here. So we're going to look to close this trade out and look to perhaps put on a new trade to take advantage of the high IV. So as from a valuation perspective, we always like to do that. Here was the price to book and PE ratio when we put the trade on basically last Friday, a week ago Friday, right? You can see the price to book pushing towards 60, now under 50. So certainly the big drop in the stock price has brought the valuations down to more reasonable levels, right? PE ratio over 200 by far when we put the trade on, right? Approaching or nearing that high level as we talked about in our previous video of over 250, which marked a significant top. You can see the PE now has dropped to well under 200. So we're able to take advantage of it, sell it over 200 back here, right? And then cover it at under 175 here. So a very nice drop in the valuations, right? So fundamentally getting more reasonable, certainly technically getting much more reasonable, right? From deeply overbought to now almost oversold levels. And the IV really didn't hurt or help us, right? So certainly had a very nice trade. How good a trade, right? Take a look at the trade. You can see we put the trade on initially, right? Selling the 1030 call out December of 28, right? And also at the same time selling the 500 put at a level that made sure that the put had no downside, right? Able to sell that strangle for over $500 at 509.50, right? At a very rich IV level, right? We're looking at almost 90 on the put side, right? The call side over 85. So certainly it got to an extreme here. So selling that with no downside, the upside we had 135 upside cushion percent wise on a stock that had rip roared already. So we had plenty of upside room as well. You can see on Friday's close, so a week past basically of trading days, that same strangle now trading under 470, right? IV's actually picked up a touch, not dramatically so, but was certainly happy to take this off for a very nice gain. So on February 27th, the last Friday, right, we put the trade on. The stock was a little bit over 700. That strangle selling the 1130 call, plenty of upside on that. 500 put, no downside because we're selling the strangle for more than 500. got $509.50. Fast forward to last Friday, we can see the stock did drop 142 points, or just about 20% exactly, right? 7 days had passed, right? But that strangle came in by 41 points, so selling at 509.50, buying it back at 468.50 for a very nice gain of 41 points for each strangle, or $4,100 per strangle. As we talked about, the margin requirement is simply because both of these options are so far out of the money, right? It's simply that 10% of the stock price. The stock was at roughly $700 at the time we put the trade on, $700.90. So a $7,000 margin requirement, even if you want to have a cushion about 14,000, right? So our risk return, right, using the lower number, right, we're able to make a basically 1 week return of over 50% with the stock dropping here on a fairly safe trade, absolutely zero downside, right, and over 135% upside. So hopefully provides an insight into how we identify trade opportunities, go about structuring, and take advantage of high implied volatility, overbought stocks, overvalued stocks, find that edge, put on the hedge by selling a strangle in a fairly neutral fashion, right? But as we always know, trading is always about probability, not certainty. So make sure you position size accordingly, take the stop so that you're comfortable with, and if it hits there, get out or at least reduce the trade. And make sure you always look at volatility as an opportunity. So until next time, as always, here's a good trade.